Okay, as we proceed, I am now going to show you the presentation that I have used for the better part of 10 years, and it was just it would never fail. And so you'll see, I'm going to go through it right now. So as I dive in, I got a lead, somebody sent in. I go ahead and go to their door on an appointment, ask them about what they had in mind when they sent in that lead. And in that case, it might be a final expense or a Medicare lead, things like that, mortgage protection and whatever. This works every time because anybody and everybody is going to want to protect their assets. And I show them how to do it. And the things that we talk about, everybody needs to pay attention to. So after I do our warm up, which is actually HELP, that's an acronym for home, employment, loved ones, and policy. And so we ask them, how long have you lived in your home? Any pictures on the wall? We compliment them on their family, how beautiful. This one couple, they were in their 80s and they had over 60 children, grandchildren, great grandchildren. Amazing. You meet just an amazing people out there. So as we finish up talking about their loved ones and then their policy, which they'll explain what they have or what their transition might be, about what they're looking to change or improve. Well, I'll just go ahead and draw this on a piece of yellow pad paper. And as you can see, it's not very organized, even though I'm a sign painter by trade and an artist, and I can draw a perfect circle. I don't do that on the paper because it's just not realistic. Now, this is not a trampoline, it's actually a table. And we talk to people about their assets because, I know for myself, I've worked hard to gather my assets together, annuities, IULs, real estate, rental properties, raw land, 40 acres in Arizona, and on and on. Now, they might or might not have all that, so you're going to ask them, but you're going to start off the conversation by saying, now most people, Mr. and Mrs., find that their house is their number one asset. Would you agree with that? And they always say yes. And so then I would say to them, well, you wouldn't want to lose your assets. What else? Let's just put them on the table here, just kind of lay them all out on the table, and let's find out about your assets so that we can show you how to protect them better. And they would say maybe something about cars, or it might be an RV, it might be a pension, it might be a it might be some land. I find that people who buy raw land are very smart, have really good assets. Might be some real estate, but not in the averages, 90% of the population are not going to have much more than this with a savings account. And I'll kind of coach them along a little bit, and I'll say, what else do you have? Maybe a CD and or a money market account, maybe some stocks. Are you in the market? And we'll find those things out. And then we have their assets on the table. Now, Mr. and Mrs., if you had any situation where your medical bills or some other catastrophic event occurs and you are caught off guard, it could be these four legs are designed to actually protect your assets. They're strong and they hold up your table of all your assets. Now the thing is, if one of those legs actually breaks, or you have money flowing off of your asset table into that leg to support it for a while on expenses, that's going to also drain your assets. And then you don't want what some people have experienced, and that is what's called spin down. And we're going to try and make sure we prevent you from experiencing spin down. Now, so do you have anything to kind of clump all these assets together in a protection like a living trust or will or anything like that? Would you have that? And no, they say no, we don't have that. Okay, so what we have to work with is just these four legs protecting your assets, and then we can actually talk a little bit more about some asset protection beyond what I'm going to show you today. So the first leg of protection is your health insurance. Now, I'm oftentimes talking to people on Medicare, and that's often the lead that brings me in the home. And then I'll just talk to them about Medicare A, and Medicare Part B is the first leg. And as you have those protections in place with Medicare, I go through line by line, and I won't do it right now, but I will list the first part. The first benefit period deductible is 1 to 60 days, and that deductible is $1,288 that you would pay out of your pocket for that 60-day window. And then there's the 61 days to 90 days, and that benefit period is going to be paid daily on the hospital stay, and that's for $344 each day from 61 to 90. Now these are consecutive stays. My father was in the hospital for 3 months straight. So we went through the first benefit period and into the second benefit period, and it was more than 3 months that he had pancreatic cancer, and over that period of time he eventually had expired, and that was back in 1989. Now 91 to 150 days, if they're not on Medicare, you would ask them about their major medical plan, if they're getting benefits through work, and how much does it cost, all the details on this leg for their health care. But then after 91 to 150 days, this number doubles to $688 each day deductible on Medicare in the hospital. That's an inpatient hospital stay. From 151 days and beyond, Medicare stops paying. So they're responsible for everything on Medicare, and that's no catastrophic coverage. They're actually really up the creek if they had something that was very serious that would keep them in the hospital for 6 months or so. So that's the Medicare Part A in a nutshell, and I'll just say it like that to them. This is Medicare Part A in a nutshell. Maybe they're going on to Medicare soon. Maybe they're already on Medicare and they're in a position where they're looking for something that might be more affordable. And Part B Medicare is for hospitalization. Part A doesn't cost anything because people paid into the system for over 10 years working. Minimum is 40 quarters or 10 years. So there's no cost to that. It comes automatically the first day of your birthday month going on a Medicare. Now on Part B, there is a $121 premium that people pay each month. So the monthly premium of $121 is deducted out of their Social Security benefits check every month. And in addition to that, there's a $166 annual deductible, and that annual deductible is for Medicare Part D for the for the doctor visits, emergency room, surgeries, and all that. So if we were to look at the Part B coverage, I usually do that through a doctor bill. So here's a doctor's bill, and let's say, for example, I had my gallbladder out, and it was $10,000 for my gallbladder. So if you had that kind of surgery on Medicare, it was $10,000 for me, and I had to pay a 20% copay through Blue Cross Blue Shield, my individual health plan through my family, and I'm self-employed, and so it was $2,000. Now, a person on Medicare would have Medicare do a couple things that are actually pretty good. And that would be, they're going to first wipe out that $10,000 and they're going to give it what's called a customary and accepted charges amount. So that's 70%. So the 70% here whacks out the $10,000 bill, and it's now 70%, and Medicare is going to pay their 80%, and the 80% is going to be $5,600. And then after that, you're going to pay, the client, the remaining 20%, and the 20% is going to be $1,400. And now that totals your $7,000 bill. Now the difference between $7,000 and $10,000 is $3,000, and those fees, the extra $3,000, are called excess fees. And these excess fees are actually uh, not going to be charged to you without you knowing it. So you tell the people that if you find out that the doctor's putting a form in front of you to say that you're responsible for your excess fees, don't sign it. That would make you have to pay it. But you just say, no, I'll find a doctor that accepts the customary and approved charges. And so that's really Medicare A and B in a nutshell. Really, it's not that complicated, but when you try and read it in the book and try to look over the charts, it really does look crazy, impossible. But that is the one first leg is the coverage for the bills for hospital and their health care. Now, the second leg, however, is one that is the supplemental type of coverage. So if a person's not on Medicare and they have a major medical plan, they might have something over here on the second leg that would be possibly, when they can't work, and a disability plan. So they could have a disability plan if they're disabled and can't work. That's a possibility to have right here. That's what you're going to ask them. What else do you have in terms of your health insurance or ancillary products? And if you have any disability coverage, if you can't work, and or any cancer, heart attack, and stroke, because those are something that 1 out of 3 Americans get every year, and you don't know if it's going to be cancer, heart attack, or stroke. And our benefits are going to pay out a lump sum up to $50,000 at the first diagnosis of cancer, heart attack, or stroke. So this would be one of the other policies that maybe they would be interested. I had one lady, after I sold her a Medicare Advantage plan, I talked to her briefly. I had done this and I showed her the cancer, heart attack, and stroke, and she said, I want that. I said, I want my husband to have that. And so her name's Vivian in Crow's Landing, and got her all signed up on alignment, and then I went to their home, signed her and her husband up on the cancer, heart attack, and stroke benefit, and well, it gets better than that, but it's not. I'm not going to tell you about it yet. So heart attack, cancer, stroke. Now, if a person is on Medicare, they can have the cancer, heart attack, and stroke up to age 65. They can enroll in that. So if they're not on Medicare yet, but they're like 6 months or 4 or 5 months before their Medicare starts on their birthday month, the first day, then they can get this. That's these products that fit over 65 and under 65. But at this point, when we're talking about the second leg that protects your assets, we will be talking about the Medicare Supplement plan. And a Medicare Supplement plan, nowadays they call it a Medigap plan, because it pays the gaps that are left behind after Medicare. So on the Medigap plan, you have a premium that you pay on a monthly basis, and that premium is going to take care of all of your bills 100%. Have you ever heard of 100% coverage, Mr. and Mrs.? It is the very best coverage to have. How that works is you pay $136, and that's monthly. And you pay this, and what's going to happen is that the Medicare Supplement is going to pay all of these co-pays that are left behind. For example, it's going to pay the co-pays that you have that you were going to pay, like this $1,288. They will pay that for you, so you don't have to. And then I'm trying to get this to be a different color and see if I can get it to be. Oh, there's one there. And then the $344 you pay For the second benefit period in Medicare, the supplement pays that. So as long as you are paying the premium every single month, then you're going to be protected at 100%. The 688 each day deductible also paid. The 151 days, you get an extra 365 bonus days. We call them the lifetime reserve days. And those lifetime reserve days will just pick away at that if they go consecutively from 1 to 151 days, and days 152 and beyond, they'll just not check them off one at a time. But these are for your lifetime. Now I'm going to throw in here also as well, there's a skilled nursing facility benefit as well, and that's going to be from 1 to 20 days, no cost to the client. No cost. That's zero copay. However, days 21 to 100, that's 80 more days, is going to run at a cost of $162.50. And that's what it is right now, here 2017. That will sometimes go up, and well, it's guaranteed it will go up. But for right now, that's what the skilled nursing facility coverages. Now I make it very clear to them that that's for people who are recovering and not people who are sick, in worse health in terms of their going into a skilled care or nursing home. That's for not recovery, that's chronic. And so acute care is what this is right here. Chronic care is an assisted living facility. So there's two different sides to skilled care. One, you're going to get better. Another, you are not going to get better. So with that being said, with the supplement in place, and I'll finish up here what the supplement pays going forward, with the $136 a month being paid each month, and I just drill that into them, it's predictable, budgetable, something that you can plan on, depend on, because you pay that, you pay nothing outside of your pocket, period. Don't take your checkbook, don't bring your wallet, go to the doctor and just show them your card for your Medicare and Medicare Supplement cards. And in doing that, this $162.50 is paid for as well 100%. And you know, that benefit comes up to over $16,000. And these benefits here can run somewhere between either $8,000 for the first benefit period, $10,000, well, more than that, plus $10,000 plus for this one here, and $30,000 for the third benefit period or more. By enrolling in your Medicare supplement to work with Medicare and paying all your bills 100%, that would be awesome, wouldn't it? Now, a person would have to have and get a sign up for a Part D. That's a PDP, standalone Part D drug plan. That's going to run about $22.50 if they don't have too many drugs. If they do have quite a few drugs, then they can go up to a preferred plan. And then if they have even more, like I have somebody who has 16 medications, then you would go to an enhanced plan, and those are going to be $100. And so $22.50, about $45, and $100 for the value plan, preferred plan, enhanced plan. You're going to learn all that in the certification process of learning about these plans from each different Medicare carrier. So there we go. We've got our leg number 1 and table leg number 2. Could also be, I'll just go through a few more, it could be dental and vision and hearing, because Medicare does not pay for any dental, vision, and hearing coverage. People, you know, really don't like that. So you can get them something that's going to run them about $13 a month, and it's going to pay up to, and this is my up to sign here, 60% of the bill. So how would you like to have $100 and you pay $40 of it for the dentist or the eyeglasses, etc.? So that's also available. In addition to that, we do also have leg 3 is for the long-term care benefit that can be acquired. And if you aren't certified to do that, then you can, you could pass it on, refer that. That's okay, and they can pay you a finder's fee. Or if you want to go to their certification course, then you do that, and then you can write long-term care business as you find people. That's how I've done it all these years. It's just they fall in my lap. because we talk about it. So this third leg is where how much does it cost typically? And I ask them this question. Now, my presentations are all about asking questions. How much is a nursing home going to cost? Nowadays, whatever it is, it's going to be more than that because of inflation going forward by the time you might need it. 1 out of 3 males go into long-term care, and then 1 out of 2 women go into long-term care. So that's really because the women take care of their man, and then it's the turn in turn the women go in there, and there's nobody really that will take care of them. So 1 out of 2, that's a high percentage and the risk. If you knew that on your block every other house was going to burn down, wouldn't you be buying fire insurance for your house? That's what it is. This long-term care, it hits people, and even more people are being diagnosed properly with Alzheimer's disease and dementia, and nursing homes are popping up everywhere left and right. So you have to pay attention to this because it's another money-making opportunity. And you don't want to miss out on that opportunity when, as I have experienced in the past, I walk out of a home with 4 policies or 8 policies because I do all 4 of these legs. Many times I had one home, I got 13 policies in one home. That's because you have to know how to cross-sell. We call it bundling. Now, I will say this, if you're talking all about Medicare here, you don't need to have any scope of appointment. You don't have to have any permission in advance. Go to the appointment and talk only Medicare. However, that would be Medicare Medigap Supplement, not Medicare Advantage or Part D. Speaking about Part D Medicare, here is really kind of going a little bit on the line of the Medicare rules. But it's just a small policy. You want to just kind of mention it. You can get a scope of appointment and sign them up for it. But we're not talking here about Medicare Advantage plans at all. We just we don't want to do that unless we did get a scope. Now, if your client says, I want to know about the plan that my neighbor has, she said it was a Medicare Advantage plan, including Part D, do you have those plans? I'll say, yes, I do. For me to talk about those with you, you can sign this paper right now and I can talk to you about that. But let me finish up what I'm doing. So you can do that right on the spot if they bring it up, not if you bring it up. And you know what? 8 out of 10 times they'll bring it up because they've talked to their neighbors. So long-term care, it's one of those things where people don't want to spend the money on it. However, it's second to dying that they are going to have something happen. Same as heart attack, cancer, and stroke. They're about 1 in 3 people get those 3 things. And so in this particular section right here, you really can find a lot of people that will get this leg 2 and leg 3 protection. So we don't spend a lot of time on that. We're just saying, look, these are the legs and these are the products that protect your valuable assets. These assets, your pension, your CD, savings, your car, get you around town to your doctor's offices, your house, is hopefully it's paid off. And that you want to prevent from having to sign that over to Medicaid and or lose it because of big bills on something you didn't pre-plan or have coverage to pay for you, for you on your behalf. You don't want to be paying for this stuff 100% out of your pocket. Absolutely no way. So the 4th leg, and we're going to wrap it up, is just going to be something that 100% of us are going to use. And what I do is I just ask them, nowadays, what does it cost to have a burial, a funeral? Oh well, I just buried my mom or my dad, and yeah, we experienced that. I said, well, so do you have any pre-burial plans in place? Do you have anything that like maybe you have bought the plot? What do you have for that? And they tell me, no, we don't have anything. Okay, well that happens very frequently. Don't feel bad about it. But the thing is, you really need to take care of it now while you're younger. Let me explain why. The cost of it's going to cost you less as you're younger. You could go and pay up front for pre-burial from a mortuary funeral home, but if you die while you're paying that down in payments, they're going to want you to pay it off. Well, You're not around. So who's going to pay it off? Well, that would be your kids, or your savings, something. But if you buy a specific burial plan, it's called a final expense plan. It pays for final expenses after you die. Then you'll be able to have, 100% of your burial paid for. You could buy the plot. We usually go around $10,000 for this. And at your age, because you're, 60 years old right now, you're only going to pay like $42 a month for that, and that's never going to go up, and the $10,000 is never going to go down. So this is called level benefit, level premium, and you'll find that you've seen on the TV where they say, "Oh, guaranteed issue your funeral plan, blah blah." That's a sales pitch, because what they do is they have a block. They call them bands, and the band is age 50 to 55, and then 56 to 61. And these bands, every year that you go into that new band, on those TV advertisements, they will raise your premium ongoing every time you hit a new 4 or 5 age band. And so you don't want that. You want something that's going to never go up. You want something that's going to help you to maintain a level, cost, so that as inflation rises, your insurance doesn't. We get you enrolled into your own individual final expense plan, and we will help you plan for your burial. And I call this set it and forget it. And that's what we do for you, so that you don't have to think about it anymore. Because, I know that you have wanted to do this. I meet a lot of people and they say, I've really been meaning to do this, just haven't done it. So let's just put it to rest, get it done. Mr. and Mrs., I'm confident that as we put this final expense plan in place for each of you, your family members will have the knowledge that you care about not leaving this burden to them. Wouldn't it? And what we have is an opportunity here to take care of all of it today, or we can piecemeal it. But let's talk about that. What I would recommend are two different ways. So you've got one way is option A, and another way is option B. Now you can see how I just left just enough space here on the bottom right corner to be able to put it out here in writing. So when you talk about option A, and you're ready to go through these numbers, I have them pretty much in my head, and I just do an estimate. I don't have to look up the exact numbers. I just kind of have an idea. Now, if I had no idea, then I would definitely look up the numbers. But what this will be is Part A is going to be a Medicare supplement. So we want to put down here, let me get my drawing tool again. And so it'd be a Medicare supplement, and that was the 136 a month. That's AARP or Oxford, the same price. Mutual of Omaha, same price. And then you have the PDP, which is going to be the standalone Part D. That's $22.50. And then I would recommend, of course, you'd want to protect yourself from the cancer, heart attack, and stroke. And that's going to be $39 for that. And that's a $10,000 benefit, a cash check to you at first diagnosis of cancer, heart attack, and stroke. And then lastly, you'd also do a burial plan. So we'd have to do your final expense plan, and that's going to also be about $40. And all total, this one Part A option will cost you $235 a month each. That'd be for you, and then also for your spouse. $235. Well, I often have them say, well, so are you telling me that the $800 that we're spending on in the marketplace, Obamacare, we're spending that $800 a month, and I'm going to be able to get that for $235 out the door, and that's 100% coverage. I don't have to pay a dime for anything, and I have these benefits for the burial, to pay $10,000 for my burial, $10,000 for heart attack, stroke, or cancer diagnosis for the first time. I say yes. Or if they don't repeat it back that concisely. The second benefit, the second part B offering or option would be, now we haven't talked about the Medicare Advantage plan, but you've got to utilize that as an opportunity for them to save a ton of money. On the Medicare Advantage plan, it comes with Part D. And we're going to just assume here at this point that on this particular meeting, we did get the scope of appointment. Let's just say that we did get that signed in advance, 48 hours, and then we brought it into the meeting and we had that. So Medicare Advantage Part D, that's Part D embedded in the plan, major medical, and with alignment, there is no extra premium. In addition to their Part B premium of $121, there is no extra premium. So that opens it up for getting them more benefits in other areas, which is more broad coverage, which is better for them. So what we would do here is the Medicare Advantage plan plus the $39 for the cancer, heart attack, and stroke $10,000 benefit. Plus we would do even more on the final expense. We'd do like a $50 final expense plan, give them $15,000, the 15K for that, and then we would also give them the long-term care $50 coverage, which would only give them maybe a year's worth of coverage, 360 days, a short-term care policy, and that's also going to be, well, that's actually a pretty decent benefit for that price. They'd end up getting paid probably $3,000 times 12 months. That's a $36,000 benefit for $50 a month. But that's going to be a total of this B option of $130. And so I say, Mr. and Mrs., of your current budget that you have, which of these two packages of benefits would be better suited in your budget to be able to afford them? Is it going to be A or is it going to be B? And then I shut up and I don't say a word. And I've had it go to be uncomfortable waiting. I make a sigh, audible sigh. This is their moment to make a decision, and I don't talk until they do. So this is how we do it. I did it this way for years and years and years and years. And then I got into annuities, then I got into more focus on final expense, and then I got away from it, and then I got back into it. And I can tell you without a doubt that this is the best presentation out there because it sells the most products. Let me just add a footnote here that I could have and should have probably asked more tie-down questions. I got a couple good ones in there, but you need to learn that process of tie-down questions and use them when the moment arises that you want those yeses rolling in one after another. So again, get the book How to Master the Art of Selling by Tom Hopkins. Now, I'm going to give you two other presentations, and they're not going to be this complete, this thorough. But you're going to have to know this stuff even on the other presentations because you'll be talking about one particular policy that they showed an interest in, and then they're going to sidestep and they're going to talk and ask you all these questions about Medicare. And you need to be ready for that. And so I want to wrap this up by just saying I have this as a script. I have it on a recording. And now you just saw it. You can play it over and again and again and again. But it works. It protects their assets. It makes sure that they don't lose their house and have Spindown, because I've seen it happen. I met this one sweet little lady who was in the Section 8 housing, and she said that she had survived 2 husbands. Her first husband of 45 years, he drained all her assets from her business. She had a booming business, took all the assets for being in the long-term care assisted living, and then she got remarried. And then the second husband, same thing, went into an assisted living facility and drained any last bit, squeezed out the last nickel of her assets, and there she was sitting in this little tiny apartment and had no money to speak of. However, she was a dynamic woman, but that's what long-term care will do to people. So I am going to move on to the next presentation. Hope you enjoy. Okay, as a quick overview of this type of presentation, I'm setting up here in the system as the second, and the third one will follow as a flip chart from Chelsea Insurance, the way Matt does it. This is actually the way I've used it a number of times. Once in a while you can't get to the kitchen table. I've seen it piled up with letters and things. You've seen the hoarding show. I've been in homes where they have been in pretty bad shape. You have the choice that you don't have to go in there if you don't want to. I had one house that had 9 cats, and I'm allergic to cats. So I wasn't rude or anything. I went in there, kind of asked her a few questions, and then I just excused myself. That's something that you have to gauge in your own mind. But what this is actually the Thomas Jefferson T-chart, and I would use it when I was sitting with people in the living room, and then I wanted to go to the kitchen. I would even say, let's go to the kitchen table. They'd say, oh no, it's got too much stuff on it. Or I walk in and I see, even from the front door into the kitchen, that it's piled up, maybe with taxes or whatever. But generally speaking, if it's just too much to remove the stuff, then you don't want to do that. If it's just a few things and you can talk them into going to the kitchen table, that's what I would recommend. The tabletop presentation for that, and of course, if they do have assets and to protect, then use that one. This one is if I'm sitting in the living room, I got the coffee table between me and them, and I want to take out my yellow pad of paper. And so here we go, place there. And we're going to go into drawing out what we would do. In this case, I would just ask them some questions, and if you know Thomas Jefferson at all, he did what's called the T-chart. And in this T-chart, basically what we're going to do is do a side-by-side comparison to see which one of their current plan is, or whether or not their plan may have some holes in it. We could help them out by getting better or more insurance in many different areas. So we ask them about their health care and if they earned it through work, if it's working well. If they're going on Medicare, you have to always understand that the Medicare side is workable. And when Medicare Advantage plans came out, opened the door wide open for us to replace Medicare A and B with the Medicare Advantage plans Part C and D and get them more coverage. And they might be, like I saw one just the other day, this last week, and he was paying $370 a month on his Kaiser plan through CalPERS, which is the retirement plan, and it was just way more money than he needed to spend. So you say their plan, and then you say our plan, because we are a separate company and we do different things, and they don't know about it because they've never been retired before. So I tell people, you're now transitioning into a place where you have never been before. Your parents may have done it without sharing with you what they experienced, but now we're going to go ahead and do a comparison. You said that your insurance was through your retirement plan. Now there's a lot of companies, so we would have an important thing to do is to learn about other insurance companies, products, and you know how I did that was just go out and see a lot of people. I just talked about it with them. They told me what they had. I told them that was the best you could have, or I told them that's not very good, we could do better. So we're going to just say, what is your insurance? And let's just say that they have, and you commonly hear this, anywhere from a $500 to a $2,000 deductible might be what they have now. Of course, they might just be coming out of work, so that's not unusual for a family plan from a group from their work. Or if they're just self-employed, then they would have something like a marketplace plan. So we're going to ask them, what are the co-pays for that plan? Well, the doctor's $25, the specialist is $70. And they range from up and down. We're just getting this information. It could be higher or lower. And then we say, well, what happens if you go in the hospital? Well, I got to pay 20% of the hospital bill. And then you want to say, well, how about if you had an outpatient surgery? What's that deductible? Well, that deductible is going to be, $1,000, or it could be the 20%. Whatever it is, the numbers are different in every situation. So I'm just using these as a hypothetical. And then we say, okay, so in addition to that, what do you have for a drug plan? So we look at their drugs, and we just get a very, very good understanding about what their drugs cost them. And they might say, well, I'm putting out $300 a month in my drug bill. Because you could ask, what is your total monthly drug bill? And then we want to go on to asking about, do you have any protection in addition to this for cancer, heart attack, stroke, and we have questions about their current health. Do you have any chronic illnesses that you have to deal with? Do you feel like you're pretty healthy? Or has anything happened in the last 3 years that's been a burden or hard on you? So we want to get a better feel for that. In addition to this, there's also the things that you're going to plan on for retirement, which would be your burial plan. And you may have come out to this appointment because of the burial lead or some reason for this for itself. But this is, again, not doing the tabletop presentation. We're just going to do it line item by line item. And then you want to ask them about, okay, do you know the difference between in a long-term care or assisted living, that's chronic care, you're not going to get well and come out of there, versus acute care. Acute care is for people who are going to recover. So we do have some very high cost that you might be needing to pay, and that for that long term, or this is short-term care, or long-term care. And with that, do you have anything in place already that's going to pay those bills for you so you don't experience what we call spindown? Have you ever heard of what spindown is? No. Well, wouldn't it be important to you, Mr. and Mrs. Jones, that when you go into a nursing facility that your bills are going to be paid for at 80%? That is going to be a powerful thing in your planning to protect your assets and your family. So what you have, I've kind of laid it out. You don't have anything in the short-term, long-term care, and no, you didn't plan your burial. And what is this costing you right now for this insurance plan? And they might say it is in employee situations. Then you're going to have one price for two people. But if you're talking to people that are already on Medicare, then you always address this as individuals. That's the way I've done it. So I would just say in this case, we're going to take this. So as a couple, have how much are you paying for this? And they're going to say something like $800. We're paying $800. Okay. Well, and you have this deductible here, and you have all these copays. So you could, in 1 year, you could easily end up spending out of pocket, a couple $1,000s. Wouldn't you agree to that? Yes? All right, so I'm going to show you what you do when you're retired folk, because I only work with the people who are in the elder stages of life, and I help them to protect their assets. And how we would do this is now you said you were close to retiring, going on to Medicare. So I want to show you exactly how that'll look like, so you could actually feel a little bit relieved and be able to see a better program. Now, because you pay for your Medicare as you pay all the taxes for FICA all these years, you get your Part A Medicare that comes to you at no cost. And then your Part B Medicare comes, and you have to pay $121 for that. This is 2017. That would be for your medical and doctor visits. And so you have here your hospitalization, which is only hospital care, and then you have your medical, outpatient surgery, and emergency room. So this is just for your medical care. And in doing that, it's going to be somewhere close to an 80-20 plan. And so on this plan, you're going to pay 20%, and they're going to pay, Medicare will pay 80% of the approved and customary charges. Pretty close to this, but because in retirement and as you're going through the aging process, most people experience more health costs, more problems, more expenses, more frequent, usage. So Medicare is not enough. What we do is we put with that, and in comparison to your plan here, we put in that Medigap policy. So the Medigap policy is designed to pay all that Medicare doesn't pay. So everything that Medicare wouldn't pay here for the 20%, you would have the Medigap policy pay that. It would be paid 100%. Medicare will pay their 80, and you would not pay any 20% for a Medigap policy. Now they've been around since the 70s. Medicare started in 1965. And what you get here is a program that has kind of moved and merged with the ages and the years that have passed, and it's still a really, really top-notch option. And we're going to show you two options in this area of healthcare in retirement. This is one option here that we just talked about, and then the other option is Medicare Part C and Medicare Part D. Now we're not going to go over that because we are going to keep it simple, and we'll look at this after everything's said and done to see if it might be a better fit for you. We'll come back to it. Now, what I propose to you, we know what you're spending here. 300, 800, that's 1,100 plus another $1,000, that you could have spent. So you're pretty much out of pocket $2,000. So you have paid 800 times 12, and you have paid out your copays $2,000. So you're basically $9,800 in this side of your T-chart. Your out-of-pocket annually is $9,800. Okay, how do you feel about that, Mr. and Mrs. Jones? That's the only thing you know. Now, if I could show you a way, utilizing all your Medicare benefits, to cut this by 2/3, so you would save 2/3 and only pay 1/3 of the $9,800 annually, then let's look at that. And with our program, with the Medicare and Medicare Supplement working together, you would actually be able to get a cancer plan that's going to help you if you ever got cancer. Now, 1 out of 3 people get cancer. So this would be, again, we're going to do this as individuals. This is a group plan, so they always price it out in your family group. This is individual plans when you come with Medicare. Okay, and I also need to point out that there's a $166 deductible with Medicare that is paid for by the supplement as well. It's magical. So $35 for the cancer. I'm just going to bring this across here. And then you have the burial plan. Of course, we got this information. You requested more information about the burial. And so how much do you think a burial costs nowadays? Are you going to be traditional burial? Have you bought a plot? Do you want to be cremated? Okay, you want to be cremated. Well, then what we'd want to do is give you a policy for burial that's going to pay at the time of need to your beneficiary children, so they go in, or to your spouse, and they go into the mortuary together and plop down the policy and say, this is all we have to spend. It's all that mother and dad wanted to spend. We would put that probably at about $6,000, because there's lots of things to burial that you probably don't realize. Opening and closing the grave, flowers, services, all that around. Even a cremation. Cremation is going to run around $2,000, $2,500, depending on the service place. And don't forget the obituary. Wow, aren't they expensive nowadays? You will have other costs like credit card bills, utility bills, and other services that are required to do that are state related. So this one, I would put this at about $30 a month, and it pays when you need it. The other plans that the mortuaries would sell you, if they put, and that would be at about 150 or more a month per person, you'd have to pay that off if you passed away while you were making payments. They would require you to pay it off in full. So that's the burial side, and then what we have here is the short-term care, long-term care. Now, 100% of people are going to pass away, and so you're going to always get your money. And then you have the Medicare side. You're going to be having more and more service needed, so you need to increase your benefits now at this stage rather than decrease them. That's the huge difference, is what we're doing. And with the long-term care, short-term care, 1 out of 3 people go into a nursing home, and more are, because of the Alzheimer's and how they're being more detailed oriented about qualifying diagnoses of Alzheimer's. So you got to understand that more and more people are going into nursing homes nowadays. They're popping up everywhere. 1/3 of people. Now that's the men, and if you look at the women, then it's about 1 out of 2. So this is men and this is women. 1 out of 2, because the women take care of the men, and the women typically on average live 7 years longer than the men. So we'd want to at least get a plan for the wife, spouse, so that we can be sure that you are covered. And the best thing to do is get one for both, because you never know who's going to be first. So that to basically take care of the skilled nursing facilities, which run somewhere around $4,000 to $5,000 for 1 year benefits, you're going to probably run about, for both of you here now, is going to be about $140 a month. And that is going to take care of either one of you at a benefit of about $3,000. So if the facility is $4,000, you're going to get $3,000. You're going to still have to pay $1,000 out of your assets, savings, or maybe your Social Security check, and that'll be how we take care of that. So $140 a month, and then you're protected. Your assets are protected. The worst case scenario of having to go into a skilled nursing facility, that's the chronic side of care, not the acute side. So on Medicare, they have some recovery center care. It's called long-term care, and the long-term care is going to cover you for about 100 days. So that's what Medicare does. All right. So let's kind of take a look here and add up some numbers here for an individual, as we always go individually. Medigap policy is going to be $136, and then you have the cancer, heart attack, and stroke, $35, and then you have $30 for your small cremation burial plan, and then you have $140 for your skilled nursing long-term care assisted care. What I come up with here is $341 a month times 12 is $4,092. So $4,992 is your out-of-pocket maximum, the maximum that you could spend, because it's the premium, and these premiums rarely go up. The Medicare Supplement might go up 3 to 6% a year. The actual burial plan will not go up. It'll stay the same. The heart attack, stroke, cancer, first diagnosis benefit at $10,000 won't go up. $6,000 there. So total that up to basically $3,000 benefit there times 12. And then you have $30 is $360, $360. And then $35 a month times 12 is $420. And protecting your assets, that would be premium equals annually $2,736. That is totaling the Medicare Advantage plan. That's the $136 a month for 100% coverage. You won't have to pay a dime, and you'll pay the $136 a month, and then you have the $35 a month. That's for the cancer, heart attack, and stroke, and that's a $10,000 benefit for that at first diagnosis of cancer, heart, or stroke. We don't know what it's going to be. $30 for the $6,000 final expense plan. So that shows all three of these. 136, 35, 30 is going to be annualized $2,736. Now look what you're spending again up here. That's with your copays. You don't have any copays here on the right side with Medicare and Medicare Supplement. No copays, no deductible. It's 100%. And then your $9,800 also, you had none of these other protections. No burial, no cancer, heart attack, stroke, no short-term care. And with the short-term care, I'm going to put that across here. That's going to be really an option. This would be without the short-term care, the 2736. And so with the 2736, if you add the short-term care to that, which is $140 times 12, then that's 1680. So 1680 is the short-term care for one full year benefit. I'm going to give you that total of the benefits here in a second, but you take that is annualized with the 2736 plus 2736, and you're at $4,416. So $4,416 is what annually you would pay. Still half of your $9,800. So for basically the same amount of money you're paying right now for your health insurance, you're going to pay for everything that covers your assets, the burial, the cancer, heart attack, stroke, and the long-term care for $4,416. If you didn't want to do the long-term care, you can take that out, and then it would be $2,736 with the cancer, heart attack, and stroke, burial, and the Medicare Medigap policy. If you want the Rolls Royce, the Cadillac, the best of the best, covering you with a benefit, this is your annualized top of the class with the short-term care. Your benefits are going to be, by just paying that, you're going to be protecting your assets. $43,000 of asset protection they will pay out for you for any of these services. That's the $10,000, $6,000, and the Medicare Supplement paying 100% of everything. We really don't have that factored in here because we don't know what that'll be, but that's huge. I think that you can see here that when you go on Medicare, you're going to save a lot more money than you really ever thought possible. So my question to you would be, based upon these numbers, out of your discretionary income that you have, if you take away the $9,800, could you afford the $4,416 a year? And you're wiping out the $9,800. You could pay half of that and have all these benefits. And or if you don't want to pay that, if you did the $2,736, it'll give you the burial, cancer, heart attack, and stroke, and Medicare Supplement. And that price, the $2,736 divided by 12 months, is a $228 monthly premium. That is nothing compared to what you've been paying at $800 a month. Case closed. I just want to ask you this. Would it give you the peace of mind you're looking for if we were to be able to enroll you, if you qualify to enroll in these plans? Is this something that you would be willing to move forward with? Okay, so that's it for now. That was a short quickie on that. It depends on how much time you have in the household. Sometimes people are really, really antsy and you've got to shorten down this thing quite a lot. But you do want to always cover all the areas of risk. And so you can, get one thing maybe out of the four, or maybe they just want to do the Medicare Supplement. Maybe they just want to do, the burial plan or the cancer plan. I've had people just pick and choose a la carte. So I'm going to sign off for now. Thanks very much. We'll talk to you soon. Okay, this is the second presentation. It's actually put together by Chelsea Insurance, and I just wanted to show you there are many options on your presenting, whether or not it's the tabletop presentation, a flip chart, or a yellow pad. That's usually the most common used. And so here is the presentation. I'll go through it pretty quickly. It encompasses kind of a flip chart feel, but it's a PDF file. You can print off the pages and put them into a flip chart. This is where you would put your state insurance license. And Matt from Chelsea, he recommends you print it on parchment paper, which I did that. So I have this presentation. I have it as a backup. If I really just want to talk final expense, then I could just stay right on the subject here rather than doing all four legs of the tabletop presentation. So when it comes down to the slide second, that's the introduction of View the Agent. That's Matt McRae with Chelsea Insurance, and he's out of Troy, Ohio, and a real energetic guy. Really like his Monday morning training calls. So you write a little bio about yourself with your insurance license and put a picture. I put a picture of my family in that particular spot. And this sheet just shows basically the carriers available with the Chelsea Insurance Company. We have chosen to use only about 4 of them. We have a couple of these that are already with another carrier, so we do have a good mix between the two. And so that's just to show your client that you have a lot of name brand providers. And here is why you need protection for final expense. Did you know? And so these are good kind of fact-finding things. The Social Security only pays $255 a lump sum to the survivor, and the survivor doesn't get anything or any children. The average funeral cost between $3,000 and $12,000, the most falling between $3,500 and $8,500. That's about right. Although my mom's funeral was $12,000, we put her in 2 different locations in terms of her services in Washington, then in Southern California, where she laid next to my dad in Rose Hills and in Southern California there. And now this last item, I don't think people touch on it very much. As a couple, if you lose a spouse, then your Social Security benefit as the survivor, with all the same bills in the household, your income is cut by 50% because you've lost that second Social Security income. So it would make sense to really look at that very closely and really run the numbers with the person to show them how much they're going to have to make up for that loss. And if you can get them to buy another, $5,000 in burial or final expense benefits, then that's going to allow them to have a little cushion there to, get through the lean times and trying to figure out how they're going to survive, what they're going to do. Maybe if they're in a house that now they can't even afford the house. Something to really, really want to hit a home run on that for their sake. Okay, so next is funeral costs as they do come together here for 2017. Professional services, obviously, these are going to be from the clergy and or people that are working in the industry, servicing the people who come to the funeral. There's lots of different places to have the funeral. So transfer remains to the funeral home. See, we actually had to transfer my mom from Washington to California, and then so that was a big expense for that. We bought a conservative casket, the embalming, all this stuff is itemized out so a person could see that. Now, if they're going to do a cremation, that's getting more and more common, that's fine. I usually just say, well, look, that's going to be $1,800, but what about the utilities? What about the credit cards? What about the remaining final expenses that are left behind for you to pay? Do you want some help with that? Wouldn't you feel better if you had some money that would just come in a lump sum and kind of take the load off? $9,668 is since the 2011 number, so it's gone up since then now at 2017. U.S. Government Social Security Administration use this form to determine what funeral will cost based upon life expectancy. Kind of a fun little chart, but just for an example, if you're age 62 here on the left, and at 62 life expectancy is 20 plus years, live to age 83 and a half, the funeral cost at that time in the future projected with inflation is $26,336. Ouch. Okay, that's for a female. And then the other for a male. That it's cheaper to bury a male. We know that it's cheaper to insure females after their menopause. That's why, in many cases, the supplemental insurance for Medicare are less expensive for females if that particular company has a gender sensitive rating. So this is to really bring the thought to home. If you died yesterday, are you prepared? How would your loved ones pay these funeral costs and obligations today? Really, I try and let people know that they really should be responsible for their own needs, and why would they want to leave that for their children and grandchildren possibly to pay? I'm turning it around saying, look, wouldn't you like to leave some extra money for your grandkids for their college? What if you could give to each one of your grandkids, let's say you have 8 grandkids, and you were able to give them $2,000 a piece as you exit this world, something for them to remember you by. It could really help a kid, grandkid. You got to find their sweet spot, find out what they want, and you have to ask a lot of questions. In my presentations, I'm just full of questions. This is the exploring your options. You have some options. Option one is to do nothing. This is really not an option. This is not about you. It's about your family. You leave behind and making sure you don't create a financial burden. Option two, acquire a prepaid funeral plan. That's another option. I've replaced many of those types of programs. They're paying $300 a month for a prepaid funeral plan. And if you die, then your family's going to have to come up and pay the balance of that. Now, the better way is option three, a final expense plan. This is ultimately the best option available. With the final expense program, you will make affordable premiums into a whole life insurance plan that provides you with immediate death benefit. And I always say level benefit and level premium. So what you have here is the life insurance 101, lower payments, higher benefit, no cash value, end of term. This is a term example. Term life ends. It actually rarely is cashed in on. I think I've heard that about 6% of those policies are paid out. That's kind of not so good. So, and then the whole life option would be level payments, builds cash value, non-medical, the simplified issue whole life policy, and never expires. That is the right way for a burial plan. That's the most affordable way. That's the way we go with. And then the third way is universal life, or an IUL, in that case, maybe an indexed product. And it shows you the different types of charts are available, the whole life being the best coverage. Whereas the UL, you can see the UL right here, and the whole life here, and the term life there. Level premiums, builds cash value, earns interest, increasing costs of insurance, eats cash value. You would show this in this flip chart. The best insurance for the final expense is the middle one, whole life. The whole life burial planning approach is the affordable solution, because you're going to just pay out your first month's premium and wow, you've got your benefit ready to go. Unless you have a graded benefit, which happens, but everyone faces this hazard 100% of the time. Burial cost averages, cremation averages, as I mentioned before, they're saying 3,000 to 4,000 here. I know that a lot of people get a low bid on that. Medical bills, taxes, credit card payoff, etc. Loss of income, we talked about that. All married couples face this hazard of losing half their income of the Social Security type. And the surviving spouse will end up with that cut in pay. Social Security death benefits only $255. And so this is kind of a review of all the slides that we just went through. And so it gets over here to the guaranteed benefits of whole life. Benefit up to $50,000. I had one gentleman, he had stopped driving, chose to be taxied around by his daughter, who was going to participate gladly, because he bought her a SUV. This was in Utah when I lived there. And he actually, got a lead. I went out to see him. He said, well, I've got the shakes and I don't drive, so my daughter takes me to all my doctor's appointments and everything. And so I bought her a car. I paid the payment for it. So I want to have some life insurance. If I die, the car will be paid off. I said, good idea. So it came up to pay off the Suburban, I think it was, to get that paid off upon his death, and him not paying that payment anymore. It was about $110 premium. And he was just in this little apartment, and I just thought, well, that's going to be too much money. But he wants to do it at this amount of benefit. He bought that at that price, and we wrote him up, and he got that policy. And so, I mean, that was a really nice commission. It was over $1,200 commission on that particular final expense plan. No health medical exam, no blood work. They just check the MIB, so that makes it really simplified. And if you do want to do full underwriting, you just have to prepare them for, swabbing their mouth and doing the urine. But we do very, very good premiums on the simplified issue nowadays. Covers both natural and accident death benefit, permanent coverage, non-cancelable. You'll have it the rest of your life when you need it, and only you could cancel it if you had to or want to. Takes the burden away from the family and friends. Peace of mind, tax-free, may also be used for charitable giving, college funds, gifts, and just about anything you can imagine. Agent service for life. When I pick up a client, I really sell myself heavily. Look, you have me as your guide. If you have the death in the family that we're trying to protect, you call me immediately. We'll get the death benefits to the insurance company. They'll pay you fast within 5 days, 10 days at the most, but quickly on average about 5 to 6 days. And so that helps them know they're not left to their own devices going forward in the future. So going on in this presentation, final expense talking points. This is something you may want to memorize, not really keep it in your flip chart. In the beginning you might, but you want to have these talking points in your mind so you can have it as a conversation. So have you ever been responsible for making final arrangements for a loved one when they passed? I have. My two brothers, we did it together for my mom, and if so, did it create a financial problem? Who will be responsible for your arrangements? Is that person financially prepared for such an emergency? Now, I only can pull from my own personal experience to say that I didn't have any problems with this. My parents were very responsible and had good investments, assets, and just something that they pretty much had planned out very, very well. So, with that being said, there's also the survival spouse income loss, financially devastating. And cost of living keeps going up and income keeps going down. Supplemental need to replace lost income during the adjustment period, which can last up to 18 months. And so then you have, well, I've heard that every 5 years that a person was married to their spouse, that's a year of mourning that they need to go through. And that's a long time. So every 5 years, 1 year mourning, calculate that for a 50-year marriage. That's a lot of time to mourn. So then you have ways to pay for these expenses. So you can save money, pay with a credit card. These are both expense, but borrow money from the bank. These are ways that you don't want to do it. You don't want to borrow money to pay for these kinds of burial expenses. Absolutely not. Life insurance is pennies on the dollar, guarantee easy, convenient, ensures your wishes are met, simple and affordable. All your plans are simple and easy to understand. We write them out for people, put it in a nice little booklet. They are all easy to obtain, no medical exams are required, guaranteed issue. Premiums are level for life. So I have to do two things here today. Find a plan you will qualify for medically. Find a plan that fits your budget. Your life insurance policy certificate goes here. I have mine. It's an IUL. My wife has an IUL. These are our plans for if we die and help to take care of the cost of the mortgage, pays off the mortgage. Show your prospects you believe in your policy so much that you own it yourself. You have to believe in what you sell so much that you buy it for yourself. How can you expect to sell others on it if you haven't sold yourself first? Sell one to your spouse and children too. So my daughter has Mutual of Omaha Children's Insurance $20,000 benefit. It is a convertible policy for 20,000. It cost me about $12 a month, and she's 21 years old. That's my youngest of five kids. Now, we're really talking a lot about your cancer, heart, and stroke plans. I have that as well myself. And in fact, I got a raise on my premium, putting it at $45. So I went and I bought it from Aetna for $35 for the exact same $10,000 benefit lump sum upon first diagnosis of cancer, heart attack, or stroke. People are afraid of getting these chronic illnesses and conditions and going into a position where they're in a terminal illness situation. And then we have the Department of Veterans. We work a lot with veterans, and they are needing our help to, make sure they have enough planning for their burial. Now, a lot of them who can be buried in a cemetery that's the veteran cemetery, that's a great thing for them to have, but sometimes it's not quite enough money to afford some of those costs for the family directly. The VA does help almost 100%. So here it says VA burial allowances are partial reimbursements of an eligible veteran's burial and funeral costs. Often those levels of service and of advancements have to be in the higher realm of an officer to get the full burial allowances. But most of your VA people haven't worked up in the higher ranks, so they're not going to get the full payment. Number one, a burial and funeral expense allowance, and two, a plot and interment allowance. So as you get a hold of this particular flip chart presentation, you're going to want to review this stuff and get it kind of in your head memorized. Who is eligible? You may be eligible for a VA burial allowance if you paid for a veteran's burial or funeral and you have not been reimbursed by another government agency or some other source, such as the deceased veteran's employer, and the veteran was discharged under conditions other than dishonorable. In addition, at least one of the following conditions must be met. The veteran died because of a service-related disability, or the veteran was receiving VA pension or compensation at the time of death, or the veteran was entitled to receive VA pension and compensation but decided not to reduce his or her military retirement disability pay, because that does adjust the pay if you take the benefit. The veteran died while hospitalized by VA and while receiving care under VA contract at a non-VA facility. The veteran died while traveling under proper authorization and at VA expense to or from a specified place for the purpose of examination, treatment, or care. The veteran had an original reopened claim pending at the time of death and has been found entitled to compensation of pension from date prior to and the date of the death. The veteran died on after October 9th, 1996 while a patient at a VA approved state nursing home. Service-related death, VA will pay up to $2,000 toward burial expenses. Now, is that going to cut it if you have a $9,000 bill? Absolutely not. VA would pay $1,500 for deaths prior to September 10, 2001 if the veteran is buried in a VA national cemetery. Some or all of the costs and transporting the deceased may be reimbursed. Non-service related death, the VA will pay up to $300 towards burial and funeral expenses and a $300 plot interment allowance for deaths on or after December 1st, 2001. The plot interment allowance is $150 for deaths prior to December 1, 2001. If the death happened while the veteran was in a VA hospital or under VA contracted nursing home care, some or all of the costs of transporting the veteran's remains may be reimbursed. How can you apply? You can apply by filling out VA Form 21-530, Application for Burial Benefits. You should attach a copy of the veteran's military charge document. Now, it's important for you to go over these determinations of the VA protection they have and benefits they have, because if you verify they did not qualify for these benefits, then you have the opportunity to write them a higher benefit burial expense plan. All right, in terms of prepaid funeral plans, it can be a ripoff. Now, I don't see this very easily, but you can get this article with the full downloaded flip chart presentation from Chelsea, and they send you an email once you're contracted, and that email will give you a clickable download that you can just get this right off. If you want to get it sooner, then give me a call and I will order that email to be sent to you, or you can call them and ask for it. So just be aware that I can't read it, I can't make it bigger. It is what it is. I had to copy it from this. Okay, and the next one is this one. Prepaid funeral plans can be a ripoff. Continued. So look for this article, 2 pages, and that way you'll be able to read about this particular. Okay, now the funeral planning agreement. This is an agreement for if a person has a funeral plan, arrangement plan, prepaid. And this is just explaining about their contract. You know, we're not big fans about pre-need planning. We believe in the life insurance. And that's why we show this, because the holes in it. And again, you're going to need to see this in the flip chart. That's going to give you a bigger reason, even more reason to order that for yourself. Okay, AARP has their own life insurance products, and they want you to they want to market those to the same people you market to. So as you can see here, the current monthly rates for a 55-year-old $10,000 plan is only $18.12 a month. However, that's not going to be a level benefit. It's not going to be a level premium. So what it says here, you know, is this is the actual letter they send out, and they say no waiting periods. Will my benefits decrease? And they do a good job of marketing this through the mail. But what you don't know, and here are the rates, and you can see the bands. So here's from age 45 to 49, $20,000 for a male, that $1,883. But when he turns 50, it's going to $2,282. When he turns 59, it's going to go up to $32, and then it's going to be up to $85. So you can see what I was saying earlier is that these bands are an enemy to the people, because they raise up every year, and then all of a sudden they're hitting $66, $87, $125 for, you know, a male 30,000. They just get sucked in, and then once the prices go up, they always cancel it. So when they cancel it, now they have nothing. The very best is to have level premium, level benefit. That's what we offer. This is a sales letter, and it's going to get their attention. So you got to prepare your clients not to be swayed. Once they have a policy with you, you're going to not want them to be swayed to these other products. It goes up every year. According to these bands, it increases every year. Level benefit, level premium. That is the only way to go. So you got to educate them on that. Your insurance policy documents go here to show that you have, offer them, present to them. This is Colonial Penn. Read your policy carefully. Again, another marketing letter about the first 2 policy years are going to be good for them, but after that, those prices are going to go up through the roof. I don't know, $50, $60. This is $111 a month that it would grow to. You know, it's just not the way to go. You've got to be converted to that, and really, you know, be passionate about educating them so they don't make a mistake. Get in a plan, cancel it because it goes up in premium. Now, this is a carrier cheat sheet here that just shows you all the different carriers. I have this right here. The carrier cheat sheet You're going to, again, I don't have a bigger picture of that, but you're going to see this in your flip chart, and you'll want to use this to do a comparison of different carriers out there. This qualification sheet is just to fill out for the information that you need to do a pre-application. And if you're using the Royal Neighbors, you do a phone call, you have a pre-sheet on that, and you have to give them always they call it the important information sheet, and you give that to them before you make the call. And then you make the call, you fill out the form, one page, and then you make the call, and everything on that page is what you talk to the lady on the phone, or the screening people for that application process. So you can use these pre-fill out forms and or the company specific pre-fill out forms. So our final expense quote here, we'll write this out. I generally do it out on a piece of paper. Rate never increases, builds cash value, level death benefit. I don't really push the builds cash value very much. I just say it'll be there for the rest of your life. I don't really want them to think that they want to take out any money on that cash value or any loans, because it's just not going to be that much money. I don't really go down that route. But this is your face amount, insured one, insured two, husband and wife. I've done many at $100 a piece. That's $2,400 premium annually, and on your contract at say 65%, where most people start out, your commissions on that would be 2,400 times 0.65, and that's going to be $1,560 right there up front, paid in 2 days if you're using Royal Neighbors and Americo. So we will wrap it up here, and this is the policy benefit summary. Policy's all written. It promises to you be the best agent you can be. Your emergency contact sheet is how you collect referrals. It's the most common way to collect referrals by writing down the names of family members and then calling those family members and say that you have just helped so and so into a final expense policy. It's going to pay for a burial, and that you wanted to introduce yourself when they find out that your client has passed away. They need to contact you, because obviously your client is gone. But we contact the family, surrounding family or friends, introduce ourselves, give our number, even an address, send them something about you. Often those things turn into business, and that's just one referral source, but it could be a good one for you. You got to be, asking for referrals. And this is the letter to cancel any policy they might have. It's just a hand drafted letter. All you have to do is fill in the name, and this is policy number. I'd like to cancel the policy. Then write in the number, and then you sign it. You witness it, they sign it, date it, send it off to the insurance company to cancel any kind of insurance that would not be a good fit for those people, or they might want to change. I had one guy, I was enrolling him into his Medicare, and then I said, do you have any work insurance you're going to lose because you're going to retire? He says, yes, I do. Or actually, I could keep it, but it's way expensive. A $20,000 policy for $125 a month. I said, well, I could do better. I got him $25,000 for $102 a month. So I saved him a ton of money, and I got him an extra $5,000. He was a happy camper. So you got to ask people, even if they have insurance, it may not be the very best out there. And so there's your cancellation as well, a letter. And then here you want, on this section 5 to 9, place carrier underwriting guidelines, rate cards, RX lists, etc. into folders in this section. And that wraps up this part of that presentation. You can see that it is very a good organized way of sharing the information about final expense and the proper planning. Also have booklets that you could actually fill in of where their children can find everything and the wishes they have on their funeral services. And those are nice, very, very nice with Mutual of Omaha. Living Promise product. Well, we'll move on to the next